When it comes to growing your portfolio, it's important to keep an eye on transaction costs. This is especially important for investors who are just starting out and who may not benefit from being able to place large trades. Let's look at an example of how transaction costs for small trades can create a higher barrier to growing your money. Let's say you just transferred $100 to your investment account and you want to purchase a stock right away. Because the trading commission is $9.95, the most you could put into a stock would be $90.05. In order to just break even, you would need to sell the stock after it has increased just over 20% in value. Here's the math on that. You purchase stock worth $90.05. This is $100 less than $9.95 commission. In order to end up with your original $100, you would need to sell the stock so that the proceeds of the trade would be $109.95, which after subtracting the $9.95 commission to sell, leaves you with $100. So to calculate the percentage increase in that stock, we take our sale value of $109.95 and subtract the initial value of $90.05 to get a gain of $19.90. We then divide the gain of $19.90 by the initial value of $90.05 to get 0.221, which converted to a percentage is 22.1%. Now, if we were placing a trade for $10,000 worth of stock, look how much less of an impact the transaction costs would be. We take $10,000 and subtract the $9.95 commission to buy. That gives us $9,990.05. In order to end up with $10,000 after selling again, we would need to sell the stock for a pre-commission value of $10,009.95. The dollar gain required is, again, $19.90 in total. If we divide this by the initial value invested of $9,990.05, we get 0.002, which when converted into a percentage is 0.2%. So you can see that it is more favorable to avoid very small trades when buying securities that are subject to trading commissions. Another very important consideration for investors who make many trades for US listed securities is the currency handling at your brokerage. Some brokerages do not allow you to hold US dollars in your account, thereby forcing you to convert funds between currencies for every transaction. In those cases, if you want to buy a US listed security, you might be required to convert Canadian dollars to US dollars first, which would incur a foreign exchange conversion fee, which might be around 1.5%, in addition to the foreign exchange spread. And when you wanted to exit your trade and sell, again, you might be forced to take the US dollar proceeds and have them converted back to Canadian dollars. This would again incur a foreign exchange conversion fee of another 1.5% on top of the foreign exchange spread. This would be doubly painful if you plan to buy another US listed security in the future, as it would have been much less expensive to just keep the cash balance in US dollars and avoid having to make multiple currency conversions. Registered accounts, as well as cash and margin accounts at BMO InvestorLine, allow you to hold US dollars and avoid making unnecessary foreign currency conversions. This could lead to significant savings for investors who make frequent trades on US stock exchanges. Here are some other general considerations about costs and how you can manage them. You can wait until you have larger cash balances before you execute a purchase. If you are regularly depositing money into your account, that might mean waiting to execute your purchases every few months. If you are looking to diversify by purchasing a number of different securities all at once, instead of making multiple buy orders, you could consider using funds like exchange-traded funds or mutual funds. Exchange-traded funds tend to have lower ongoing expenses but are subject to trading commissions like stocks. That means you could pay one buying commission and a low ongoing cost to get exposure to many different underlying securities. Mutual funds tend to have higher ongoing costs, but can often be bought without a commission. Different funds have different investment minimum amounts, and these minimums can vary depending on if you are making a single purchase or setting up an ongoing periodic purchase. For example, if you were to set up a continuous savings plan, a CSP, you could set up a recurring purchase of $50 worth of mutual fund units without paying a commission to purchase. Once your account gets larger in value, it may make sense to consider switching to exchange-traded funds or individual stocks if the transaction commissions start to cost less than the ongoing management expense ratios of using funds, all other things being equal. And finally, make sure to see which ETFs are available to be purchased without any trading commissions on BMO InvestorLine. With lower MERs and no trading commissions, they are a great way to keep costs low.